Everyone loves making quick, easy money, from casinos to sports betting to options trading. And although there are legitimate strategies involved in all three of those, most people fall into the trap of jumping in blindly. As an options trader, I see this every single day, and even if you have beginner's luck, chances are you're gonna lose money in the long run. And what are those chances? 90% of people actually. Why is that? When it comes to the stock market, options are like drugs. Stocks on steroids, really. If you don't know what you're doing, one minute you could be making a fortune and the next minute you could lose your entire life savings. Ultimately, in my opinion, it boils down to three main reasons why people fail at options trading. And chances are, if you're watching this video, you're guilty of at least one of these mistakes. Mistake number one, trading zero DTE options. Now, there are definitely profitable ways to trade options that are expiring on the same day as you buy them. That's the definition of zero DTE, days to expiration. Essentially, you're taking a big risk, a big gamble that a stock is going to move above a certain price or below a certain price within the same trading day. Most people are not able to predict such things, or else they would be millionaires. This has become such a big thing actually that there are a lot of articles being written, and you can see the volume on zero DTE options are exceptionally high, especially over the past year, as people try to take advantage of the huge volatility in the bear market. People are throwing thousands and thousands of dollars into these contracts, betting on the same day price movements of stocks like Tesla, ETFs like SPY, which is really popular nowadays. And on one hand, you could make a lot of money, right? Even if the stock goes up $1 per share, you could be making hundreds of % return on your investment. But if you guess wrong, you lose all of your money. It's expiring in like a few minutes or an hour from now. You can't do much if the stock happens to go against you. And especially when you approach 3 p.m. or 3:30 p.m. Eastern time, on most brokerages, they're actually going to automatically close out your positions because that option is expiring on the same day. Most brokerages will not let you hold those positions through expiration in reality. You can't wait until, say, 15 minutes before close, 5 minutes before close to see if it bounces back up. It'll actually get closed on you and be closed at a loss in this case. Don't blame your brokerage if that happens, because at the end of the day, it was your own decision to do this, and you have to know what the rules of the game are. It's really only a good option strategy, in my personal opinion, if you're willing to risk that entire premium, that entire amount that you bought into with this options trade, and comfortable losing all of your money for a chance to maybe make double your money, triple your money, whatever. If you have a small account and you're inexperienced, I would really suggest not doing this because it's not really a valuable use of your time. If options are already steroids, then zero DTE is the worst illegal, substance out there that you could possibly get high off of, because it's not a realistic way that the market trades, whether it's options or even just generally common shares of a stock. It doesn't really teach you much that you can apply to other areas of the market. Options mistake number two is going to be buying options. Now, this sounds extremely weird, but most people, they think of buying options when you're trading options, right? You buy a contract, you hold it, it goes up in value, you sell it, and that's how you make a profit. But in reality, there's a whole other world known as selling options. So you can be an options seller. I could sell a contract to someone else and collect their money in exchange for that contract. One strategy that I suggest to beginners is cash secured puts, otherwise known as selling to open put options. So what that means is you're selling a contract to someone else. You're giving them the right to sell you 100 shares of a stock, and in return, they're going to give you a premium, a certain amount of money in exchange for that contract. So in this example, I had a contract for Man U stock for the 23 strike price, and in exchange for that contract, I got $85. Pretty good deal. And it's especially good to run cash secured puts if you're already interested in buying those shares. So let's say, again, I'm interested in Man United stock. I recently did a lot of research into this one. I think there could be a buyout for this stock in the region of $25 to even $30 per share. So I would not mind buying this stock at $23 per share. So in exchange for that contract, right, I get $85. That's guaranteed money, passive income, you might say. And if it so happens that this contract gets executed, I have to buy Man United stock at $23 per share. Sure, that's fine. I would love to do that. And you're paying me $85 to do that? Sure thing. Be my guest. So you can actually be an options seller and be very profitable actually, because you could continue to collect these premiums, build long positions, maybe also do this other strategy that maybe is for another video called covered calls, and you can collect passive income on your long positions as well. Shares that you're holding in your portfolio anyways, you could sell call options to someone else. Most options expire worthless. So why not be an options seller, collect that premium from someone else, let their contract expire worthless. They already gave you that money, and good deal for the options seller. Now, while this video is geared towards options beginners, if you are a more advanced trader, one strategy that I personally use week in, week out is the put credit spreads as well as call credit spreads, otherwise known as vertical spreads. So for example, with put credit spreads, you're selling a put option like with cash secured puts, but you're also buying a put option at a lower strike price. What it does is that it makes sure that you have a defined risk to reward ratio, and it happens that the probability of your trades being successful is very, very high. You can see in my trade log here that over the past month, I have a win rate of about 90%. Generally, they are smaller gains with each trade, but a very consistent method of trading and solid, consistent returns. This actually goes against the typical mentality with options that you have to make a ton of money with each trade. It's absolutely a myth. Finally, mistake number 3 is going to be not taking profits or having a stop loss with your options trades. I alluded to this earlier, but the fact is that most people don't know when to get in a position and get out of a position. You need to have a defined risk reward before you get into a position, in my personal opinion. What does that mean? So there are a whole lot of calculations that you can go through to understand a profitable trading plan. I could have linked in the description here a risk to ruin calculator. I highly suggest that you check that out. What this does, it actually shows you the probability of you losing all of your money in the long run if you follow a certain pattern of trading. So if every trade you're making 10% or you're making $100, let's say, but if you consistently lose $200 a trade, obviously you're gonna lose all of your money eventually. That's an obvious example, but most people don't realize that the losses they're taking right now, they might seem small to you, or you might not be really keeping track of how much you're losing or how often you're losing. But if you plug it into this calculator, you will see that probably, if you're a beginner, the way that you're trading is not profitable and you will lose all of your money in the long run. Now, you could do technical analysis to determine what your stop losses are. You could have a mental percentage, for instance, that you worked out with this calculator that makes sense. Like, let's say I'm gonna take 7 trades out of 10 that are wins, 3 of them are gonna be losses, and my stop loss is going to be about 30%. Like, that's my hard limit. With my personal vertical spread strategy, the stop loss that I always follow is 200% stop loss. So if that position starts to go against me and I start losing 150 to 200% of my trade, I'm just going to exit it, because I know that my strategy actually works with consistent gains, and occasionally we will have some big losses. You can see in my trade log. On the flip side, there are a lot of people that get into a trade and become greedy, and that position goes up 100% or 200% or 300%, and they still don't take profits. And like we talked about with 0 DTE options, that can all quickly change. But even if you're not trading 0 DTE, there are situations where there are events out of your control, like the Federal Reserve coming out with some bearish commentary. Your company could announce a big share offering and that tanks the stock. It might have bad earnings, etc., etc. There are a lot of reasons for an option trader to go against you. And as you get closer to expiration, time is really not your friend there. So if you can take profits as soon as possible and it's within your range of taking profits according to your trading plan, I would highly suggest you do so. So with that being said, guys, those are the 3 main mistakes I see options trading beginners make. Hope you guys found this helpful. Make sure to subscribe. And if you do want to learn more about options, we have a whole course as well as our own options trading alerts in our Stock Dads Discord, link in the description, or stockdads.com. Please check that out. And I will see you guys in the next video. Take care.